Last year, a surprise rate hike from the Bank of Japan nuked financial markets the world over and sent Bitcoin plunging 30%. But if you thought that was bad, Japan's monetary woes might be about to spill over again for an Act 2 that could be much worse. So, stay tuned to find out why the market for Japanese government bonds could end up being the global fiat ponzi's canary in the coal mine. My name is Nick, and you're watching the Coin Bureau. When the Bank of Japan raised its policy rate from 0.1% to 0.25% last summer, it triggered a chain reaction that vaporized trillions of dollars from global markets in the central banking equivalent of a Thanos finger snap. This fractional increase in interest rates sent Japan's major stock indices plunging 12% in the so-called Black Monday, that also saw gold, Bitcoin, and US tech stocks falling off a cliff. I am, of course, talking about the global liquidation event caused by the unwinding of the yen carry trade on the 5th of August 2024. Now, if you're not familiar, the yen carry trade involves borrowing yen at Japan's historically negligible interest rates and plowing that money into higher yielding assets globally. Now, for context, the BOJ's policy rate was minus 0.1% until March 2024 and ranged from 0% to 0.1% thereafter. The huge difference, or delta, between these near zero rates and interest rates in the rest of the world has been the source of an extraordinary arbitrage opportunity for investors. So extraordinary, in fact, that the yen carry trade is not so much a trading strategy as a global liquidity phenomenon. Its sheer scale is a matter of debate. Deutsche Bank once floated a $20 trillion figure, while data from the Bank for International Settlements tallied Japanese banks' foreign lending at least $1 trillion by March 2024. Japan itself holds a $3.4 trillion net international investment position, making it the world's largest creditor. Whichever way you slice it, this phenomenon means that Japanese monetary policy is a very big deal for the rest of the world. They say that when America sneezes, the world catches a cold. But the events of last summer suggest that so much as a hiccup out of Japan is enough to give the rest of the world a heart attack. And that's what we saw last year when BOJ Governor Kazuo Ueda announced the rate hike to 0.25% and made some unexpectedly hawkish commentary about further rises. In hindsight, it's remarkable that market participants were so unprepared for this because there were signs everywhere. The weeks leading up to the BOJ's meeting saw a 38-year low for the yen against the dollar, tightening labor market data, accelerating core inflation, and even political pressure for a hike. Yet, a Reuters poll of Japanese economists just before the BOJ meeting showed that 3/4 of them didn't think it would happen. And so it was that the market was caught with their pants down. The yen rallied, Japanese stocks crashed, and the contagion spread globally as a liquidation cascade on August 5th forced traders to sell whatever they could to repay their yen loans. The market crash was swift and brutal, with short-term futures positions, which were the primary casualties, mostly wiped out by August 6th. However, despite the liquidation flush, the delta that fuels the carry trade did not go anywhere. The Bank of Japan was quick to nurse the markets with talk about not raising rates further amid instability. But the core issues remained. Now, all of this was quite a shock to the markets, but it was fundamentally a reaction to a change in policy expectations, or really a misreading of the monetary tea leaves by market participants and Japanese economists, apparently. And by the way, guys, if you're enjoying this video so far, then let it be known by smashing that like button down below. And if you're not subscribed to the channel, which apparently 34% of you aren't, then you can hit the subscribe button down over there. And you may as well hit the bell as well to make sure YouTube gives you a bell as well the next time we release another upload. Back to the video. So it's now summer 2025, and Japan's monetary woes have started bubbling up to the surface again, possibly preparing to liquidate us all over again with a new macro shock. And if that happens, it won't be as transient as the one that happened last year. And that's because this time, we are hearing grumblings of a more systemic problem coming from the market for Japanese government bonds, or JGBs. Recently, the market for JGBs, and particularly super long JGBs, those with maturities of 20, 30, or even 40 years, have been showing serious signs of stress. Yields on these bonds have been going through the roof recently, with the 30-year JGB yields hitting record highs, and the 20-year yield reaching its highest level since 2000. And this means that the market is demanding higher compensation for lending money to the Japanese government, especially over the longer term. Government bonds are supposed to be some of the safest assets around the world, though, so what's the story here? Well, it could be that investors are losing confidence in Japan's financial health. If that's the case, it's no wonder why, because, spoiler alert, Japan has the highest debt to GDP ratio of any developed market economy in the world at around 263%. In 2023, the government had to spend 22% of its budget just to pay the interest on this colossal debt pile. And, unfortunately for Japan, every slight increase in these long-dated bond yields results in a massive increase in the amount of money the government has to spend paying interest on this existing debt. As we'll find out, this has distorted monetary policy in Japan and left the BOJ in a very tight spot. I'll get to that in a minute. But first, what exactly has been going on in the bond market over there? Well, the first thing that you should know is that the biggest buyer of JGBs is the BOJ itself. It's been buying around 120 trillion yen, or about $828 billion worth of JGBs every year in a massive and prolonged exercise of quantitative easing, better known as money printing, to try and stimulate growth in Japan's sleepy economy. In fact, so voracious has been the BOJ's appetite that it now owns more than half of all outstanding JGBs. But the situation has changed in recent years as inflation finally started to pick up. It's pretty ironic, really. For decades, the BOJ fought tooth and nail to fend off deflation. And all of a sudden, it's inflation that's now biting the population in the backside. Inflation has been above the BOJ's 2% target for 3 years straight now and reached as high as 3.6% this April. And that's why the BOJ is now trying to pull the lever back in the opposite direction. It's pivoting to a kind of a quantitative tightening light, which in practical terms means reeling in the bond binges, scaling back from around 120 trillion yen of annual purchases to a pace closer to 80 trillion yen. And when the biggest, richest spender in the market starts buying less, prices inevitably slide. At the same time, another historically reliable source of demand is fading. Japanese pension funds and life insurance companies are facing regulatory changes and duration gaps that mean they have less capacity and desire to invest in long-dated JGBs. But that's not all. In recent years, foreign investors have stepped in, pushing the share of JGBs in foreign ownership to above 10%, which is quite high by historical standards. And this is not necessarily great news for the BOJ because foreign investors tend to be a flightier crowd compared to Japan's diamond-handed bondholders. For example, foreign investors tend to be more sensitive to US interest rate volatility, speculation about Japan's fiscal policy, and the BOJ's perceived ongoing dovishness. As such, even modest selling from this cohort can have an outsized impact in Japan. And this bearish cocktail led to some rather undignified scenes at JGB auctions in May, with one particular sale of 20-year bonds recording the weakest demand since 1987. This was essentially the market saying thanks, but no thanks to the terms on offer. This deteriorating liquidity has reportedly caused the volatility of super long JGB yields to triple, which is not a great look.
Oh, I didn't see you there. Well, now that I've got you, I may as well let you know about the Coin Bureau deals page. It's over there where you'll get $100,000 sign-up bonuses on the best exchanges in crypto, as well as 60% trading fee discounts on said exchanges. And you can also get discounts on hardware wallets. All of that in the Coin Bureau deals page down below in the description. Now you go back to the video, I'm going back to chillaxing.
Now, this conundrum has been interpreted in different ways. US financial services giant State Street recently published an analysis basically saying that there is nothing to see here because grumblings from the market for JGBs are a sign of, quote, deteriorating market functionality driven by technical supply-side imbalances rather than a fundamental reassessment of Japan's fiscal sustainability. However, what State Street frames as, quote, marginal fiscal concerns is for some other observers not so easily dismissed. A Japanese Prime Minister, Shigeru Ishiba, for one, recently warned that Japan's finances were, quote, worse than Greece, which, no offense to Greece, didn't exactly inspire confidence among JGB holders. Macro analyst and former Goldman Sachs trader Weston Nakamura has been voicing a similarly pessimistic view. He calls the JGB market itself the, quote, world's most dangerous market, and believes that long-end JGB yields ripping to record highs is the work of, quote, JGB vigilantes, investors effectively punishing the government for not taking inflation or currency weakness seriously enough. Now, since yields rising too much could cause a debt crisis, the central bank would normally step in here to announce a rate hike. Although this makes it more expensive for the government to issue new short-term bonds, it also signals to the market that the central bank is in control and indeed serious about tackling inflation and defending the currency. And this should calm the market, anchoring expectations for all future rates and thereby stabilizing the yield on the long-dated bonds. It's like the central bank choosing to perform a painful but necessary surgery to prevent the patient from dying. Heck, even the US Treasury has publicly pressured the BOJ to hurry up and raise rates. But, unfortunately in Japan's case, this rate hike surgery is likely to be a death sentence. Since the government's debt burden is already so enormous, a significant rate hike would result in interest payments so immense that they could trigger a fiscal crisis and bankrupt the state. And this is why the BOJ is forced to keep its policy rate extraordinarily low and not make any sudden moves. And you know what that means? The yen carry trade continues. The whole world is still borrowing yen and selling it for high-yielding foreign assets to capture the delta, resulting in enormous downward pressure on the value of the yen. A weaker yen makes imports more expensive, which is bad news for an island like Japan that relies heavily on imports of energy, food, and raw materials. Higher import costs are passed on to the consumer, resulting in inflation. And so we have bond market participants essentially forcing a showdown wherein the BOJ's only move is one that weakens its own currency, thereby importing inflation. And to make matters worse, since more than half of all outstanding JGBs are owned by the BOJ, a rate hike would also nuke the value of the BOJ's own bond portfolio, potentially leading to enormous losses on its balance sheet. This is what's known as fiscal dominance, where monetary policy is dictated by the government's debt predicament rather than the central bank's mandate to deal with inflation and unemployment. Now, as you'll recall, the BOJ actually has been raising rates. In an attempt at policy normalization, the central bank last year hiked its official policy rate from minus 0.1% to 0.25%, and this was then raised to 0.5% in January, a rate that remains in place at the time of making this video. But this is still extremely low, and true normalization seems like a pretty remote prospect at the moment. Governor Ueda had reiterated that the central bank would not, quote, forcefully raise interest rates when underlying inflation is stalling. I probably don't need to remind you what happened the last time the BOJ hiked its policy rate against market expectations. So in reality, the BOJ is forced to keep rates low and keep hoovering up JGBs, or at least not sell them aggressively, to prevent a financial crisis. To all intents and purposes, the central bank is just monetizing government debt, or in other words, printing money, to finance government spending. It's a structural vulnerability that continues to weigh heavily on the long-term prospects of the yen. The BOJ is locked into maintaining an enormous balance sheet, risking persistent inflation, currency devaluation, and terminal loss of its credibility. It's a situation that has only been made more tricky by the prospect of government spending rising further this year. With inflation biting the Japanese consumer, Tokyo is reportedly considering a cut to VAT to provide some relief ahead of July's election. And this is probably why the government also looks set to push back its own deadline for balancing the budget to 2026. Recently, the situation in Japan has started spilling over into another critical market, namely the market for US government bonds. Remember how I said that Japan is the world's largest creditor? Well, this has made it the world's largest holder of US government debt, with Tokyo sitting on $1 trillion worth of US treasuries. Historically, Japan has been the biggest source of demand for US treasuries, and this is why it's a little alarming that Japanese investors have recently gone AWOL from US bond auctions and even started selling their holdings. One of the reasons for this is that the BOJ has been hiking rates while the Fed has been cutting them. And this has contributed to the USD-JPY exchange rate becoming increasingly volatile of late, and as a result, it's become prohibitively expensive for Japanese investors to hedge against currency swings. For Japanese pension funds and life insurance firms who have historically sponged up as many treasuries as the US can throw at the market, the yield on these US assets is now largely cancelled out by the cost of insuring against the yen suddenly strengthening against the dollar. So, at a time when the US policy environment in Washington has cast doubt on the safe haven status of US government debt, a major source of demand has also been priced out of the market by currency volatility. And this looks like a confluence of the arguments made by Western Nakamura, and he's been warning of the prospect of failed bond auctions, where investors are no longer interested in buying government debt, and the whole fiat currency system starts to fall apart. To be sure, Nakamura doesn't expect this to happen in some dramatic bond auction standoff, but rather a slow decline in demand that is later recognized as the death knell of the US dollar-based global financial system. According to him, recent bond auctions in Japan and the US being met with tepid demand may turn out to have been the canary in the coalmine. And recently, he's made an interesting observation about how the price action of Bitcoin at times appears to mirror the yields on long-dated JGBs, both of which recently touched new all-time highs. The matter of Bitcoin's correlation with other assets is a little tricky because it seems to vary, with sometimes it trading like a risk-on asset and at other times trading like a safe haven asset. Perhaps the most commonly observed correlation, though, is with US tech stocks, like those tracked by the Nasdaq 100 index. But Nakamura has found that as the correlation between Bitcoin and traditional risk assets like the Nasdaq 100 falls, Bitcoin's price has tended to move in tandem with the yields on long-term JGBs. Is it a coincidence? Maybe. But maybe both assets are reacting to the same underlying global macro forces, shifts in global liquidity, persistent inflation expectations, and maybe even a re-evaluation by investors of sovereign credit risk. Stress in the JGB market, one of the world's largest sovereign debt markets, could be an indicator of fiat instability. When yields on government bonds are soaring, it implicitly calls into question the safe status of government debt. And since Bitcoin has broken to new highs at the same time, we may be witnessing investors de-risking from government debt and seeking refuge in harder assets like Bitcoin. If this is the case, it would mark a notable shift from the August 5th carry trade unwind, where we saw Bitcoin reacting to a liquidity crunch caused by a policy surprise. As the most readily saleable major asset in the world, Bitcoin tanked by 30%, but promptly made a full recovery once the liquidation event had concluded. This time, however, if Bitcoin continues trending upwards in tandem with JGB yields, a sign of fiat stress, it could indicate that both markets are pricing in a deeper, more structural problem with the traditional financial system, with Japan as a leading indicator. If the JGB market experiences genuinely failed auctions where the Ministry of Finance can't find enough buyers at acceptable yields, the fallout could be very ugly indeed. The BOJ's solution might be to print yen on a massive scale to buy up unwanted debt, which sounds like a recipe for hyperinflation and complete collapse of confidence in the currency. Another possibility is the government and BOJ might liquidate some of their US treasuries to stabilize domestic markets or fund emergency measures, and the sight of the world's largest holder of US government debt panic selling it would likely have immediate and severe global repercussions. All of this would likely drive demand for harder assets like Bitcoin, and of course that is good news for its price. But this is one of those bullish scenarios filed under the doomsday, where the price of Bitcoin would probably be the least of our concerns. On the other hand, maybe this is a bit fanciful, and maybe State Street will be proved right about there being nothing to see here except a technical hiccup in the bond markets. You might want to keep an eye on the JGB BTC correlation though. And since it's always wise to consider a counter-argument, why not watch this video to find out why it actually may be Bitcoin that ends up collapsing this year. And if you're not subscribed to the channel yet, well, you can do that right over here. This is me, Nick, signing off. Thank you very much for watching, and I'll see you guys again soon.